What's going on, my friends? Chris here. I want to bring you all an update of 7 things that I've learned from the last bear market that I went through. I got into Bitcoin cryptocurrency in 2017, and I got to experience this entire ride up. And during that time, I wasn't taking profits. I was listening to people saying it's never going to stop. I wasn't paying attention to charts, obviously, because I was just getting into this. And, it was my own fault, but I just kept holding and holding. And I experienced this entire bear market back in 2018 into 2019. And once you've experienced those, you'll never want to be a bag holder again. And there are a few things about this bear market that I wanted to talk to you guys about and kind of tell you my experience as I rode price all the way up and back down, and why I no longer do the bag holding situation. What I really prefer in this space is swing trading and position trading. I think that's going to be the best. Day trading with fees, it can kind of chew you up. I really think that swing trading to position trading is going to be the best, because you really get these large swings and you want to capitalize on them. You don't want them to retrace 50% on you after you've had a nice move. So as we're getting into this here, guys, I hope this can help you as we've been in this tough bear market. If you get some from this, don't forget to like, subscribe, hit that notification bell, and we'll dig into this. Number one, what I've learned: bear markets, they last longer than everyone's really expecting. At first everyone was looking at this bear market and said, oh, it's just going to be a correction. We're not going to go this deep. And I didn't expect us to go this deep this fast either. But when you're looking at it, bear markets, they can always be a little bit longer than you expect, and they can also be deeper than you'll expect. When Bitcoin was at $20,000 up here, no one was expecting it to go back down to $3,000. And then all the way back up to 69,000 in the next market cycle. So we go through these market cycles, but you have to be patient in these bear markets and understand that you don't want to fight the trend unless you're doing short-term trading. If you're trading the reactions, that's fine. But in terms of, even my opinion, guys, longer-term investing, you really want to wait to see a bottom form in that accumulation area, and then you can also get that entire stage two. So basically markets go stage one, you have that accumulation area, and this would be back in here. Stage two, you get this nice move to the upside. Many of these markets aren't as parabolic, but you get that stage two to the upside. Then typically you get a stage three distribution, and then you get a stage four to the downside. And then you start that stage one again. And many traders, they want to trade this stage two, the meat here. They're not trying to get down in here and pick a bottom. They're waiting to see that first higher high and higher low form, and then they're getting in and they're riding that as long as they can. So always realize that it can be deeper, because even on coins, say ADA or whatever, you wanted, it was at $3 and you say, okay, it's $150, this is a great price, and then it just keeps milking lower and lower and lower. And this is on many coins. It's just how bear markets go. So if you keep buying that dip, then it's going lower and lower and lower, and that's where then you have the opportunity cost of tying up your money during that time as well. So that's why I like to actively trade. So I would say swing trading, position trading is one of the best things. Really study about it, guys. After I went through this experience for the last 5 years now, I've just been studying as much as I can about technical analysis and price action. That's what matters the most. The next one here that we got into a little bit here: don't start building a position until the trend changes, until you see that actual trend change. And guys, here on the weekly chart, you can see once we got down here, we pushed up, we set that higher low, and then we got a higher high, and that's what kicked us off here, and we really got a nice move to the upside. So always looking for that trend change is going to be important. And those trend changes, they start first, if we want to go bullish, we got to get a 5-minute uptrend, then a 15-minute, then an hour, then a 4-hour, then a 12-hour, then a 1 day, 1 week, and we just have to work our way back. So it's always important to pay attention to. The next one is cash is king, because cash is going to give you great opportunities in the market. When you see something forming, you have the cash to be able to jump in and trade that, as opposed to being tied up potentially in a downtrend. So cash is king. You can really get some good bargains, and I know inflation's through the roof, guys, but if prices are also dropping as well, you could still get some really good prices, and you're still going to have some of that stability, and you don't have to worry about things potentially happening overnight, that type of stuff. So that's why some guys like to be in that cash in downtrends if they're not shorting the market. Next one is risk management's key. If you're in a bear market and you're playing these reactions, in my opinion, play smaller position sizes. That's one thing I've always done, is just really sticking to small position sizing as I'm continuously trying to learn this stuff, guys, because even 5 years in, there's so much I still need to learn about price action, about correlations. There's just so much that goes on, and I want to learn as much as possible. So I've always kept my risk really small, and I'm just trying to learn this game and be in it for the long term, and hopefully it'll pay off in the longer term as I'm learning and staying in the game and not blowing up, hopefully. Next one, if you play reactions, you must sell or have stops. So that goes back to what we were just talking about a little bit. But if you're playing these reactions, these bounces, so after a big fall like this and you're trying to play this nice reaction out of here, you always want to be selling into that strength or into that bounce. And then many times you can even put a break-even stop under your position as well and try to let that ride if that is the bottom. So always having stop losses when you're playing this, because even right here, guys, say you didn't put a stop loss in underneath, it continued to go lower, and that could have been potentially, you know, another 65% to the downside. So you always want to have those stop losses in if you're playing. You know, on the bullish side here, guys, say you're trying to get in right here, you see a really strong move, put that stop loss underneath right here, and look, if it's going to be strong, it's going to continue. And it would have continued, your stop wouldn't have got hit, and that would have been a really nice move. So those are things you're looking for. You know, guys, right here, this is a very bearish candle right here. You could put your stop up above that, say you entered, really nice move to the downside. So things that you can look at, just really using those stop losses, because if there's going to be continuation, it should continue to move and you won't get stopped out if you give it enough wiggle room. But also, whenever you see anything that's vertical going straight up and you get really long extended candles to the upside on heavy volume or on that climax volume, that's a great time to trail stop losses or take some profits, guys. Anything that goes straight up is going to come straight down, and it takes much longer typically to build a house than it does to tear it down. So these bear markets, what I was reading in a book last night, is typically for the bear market, in 2 years, a bear market can tear down 15 years worth of bullish action in the stock market. So it's much easier to tear a house down, and the bears, they jump out the window, the bulls take the stairs. And that's why many guys like playing short, because you get those moves really fast and aggressive. You can take your profit and then get out of the way. But you're looking for those downtrends if you're doing that. So that's really important, you know, to pay attention to bulls climbing, you know, the stairs, and the bears jumping out the window, how much faster the moves are to the downside, to the upside. But also, guys, don't beat yourself up too much. You have to go through one of these cycles to really experience the pain. You know, you can read about it, this or that, but you have to experience the pain. I had to experience the pain of, you know, seeing $3,000 back here go up to 25,000. Then for the most part, you know, I took some profits on the backside here, but I let a lot of it just continue to ride all the way down. And to see it go back almost to where it was after seeing those type of gains, you know, it's a hard thing to deal with. And mentally, it's tying up your mental capacity, and it's also tying up your capital, and you're missing opportunity. So that opportunity cost is something as well. But, you know, many times, guys, these cycles will repeat themselves. We'll go from that bull to bear, and you do just have to hang on. But always look for those trend changes before you just shoving all your money in on a downtrend. I hope you get some from this. God bless you all. Take care.